This is the S&P 500. Notice something odd about this? Look at the dramatic difference in allocation between the 11 sectors. This is our big secret. Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. Here's the big secret about the S&P 500 that we're going to be talking about today. The secret is that the S&P 500's returns have mainly came from a minority amount of companies. That means a very small amount of companies are responsible for the vast majority of returns in the S&P 500. Take a look at this picture from Visual Capitalist. This shows which companies had the highest returns in the S&P 500 since 1980, and you probably recognize a lot of them. In any single given year, there is just a small amount of companies that are responsible for what the S&P 500 does. And that's because we are talking about really big companies here and potentially companies that grow very, very large. And when that happens, you can bet they have a profound effect on your total investment portfolio if you're primarily investing in the S&P 500. It sounds quite complicated, right? But to be honest with you, investing doesn't really need to be complicated. That's why I do have a whole nother video that I call my complete guide to investing for financial independence. And I'll point you to that video later. Let's get back into looking at the S&P 500. Look at some of these dramatic changes that have happened over time with the S&P 500. This is another sort of secret when it comes to the S&P 500. So I did some research on this and I looked into Wikipedia, and they say that since 1963, there have been 1,186 stocks that have been replaced within the S&P 500. I don't know about you, but that kind of blew my mind. That is a lot of companies that have moved in and out of the S&P 500. And remember, the S&P 500 is supposed to be the 500 largest publicly traded companies in the United States. And these numbers mean that theoretically, every single company could have been replaced twice in the S&P 500 because over 1,000 companies have been replaced over those years. And as of the making of this video, when I did the research, the most recent company that got replaced in the S&P 500 was Palo Alto Networks, replacing Dish. Now, I don't have too much experience or knowledge on either one of these companies, but that is the most recent change that has happened to the S&P 500, at least since making this video. And speaking of making this video, just really quick, I want to say that I put a lot of research and effort into all of the videos that I make, and I would really appreciate if you could help me out really quick and just hit the like button on this video. Thank you so much. The next thing I want to talk about when it comes to the S&P 500's secret here is a most recent example. So let's look at a really recent year and look at how only a few companies can make a dramatic difference in the overall returns of the entire index. So let's look at 2022. Look at the enormous losses and gains on a company by company basis within the S&P 500. You can see that some companies did extremely well that year and some companies did pretty much extremely poorly that year. And the reason for all this madness, you may know, is that the S&P 500 is market cap weighted, which means the more valuable a company is, the more it's going to be represented within the index itself. So an extremely valuable company worth, trillions of dollars is going to have a larger market cap than a company that's worth hundreds of billions of dollars. And so if there are large returns or losses on a company that is super large, then it's going to affect the entire index a lot more. So take a look at these few examples here when it comes to market cap weighted. Some of these super large companies, including Tesla and Facebook. So these are really large and very valuable companies. And so when they have outsized returns, it's going to affect the entire index to a great degree. But what does this have to do with us everyday individual investors? Because you might look at this and say, hey, if I pick the right company out of these 500 and it does extremely well, then I can make a lot of money. And maybe that is the case. Maybe if somehow you got lucky and picked the right one that had a really great year and you sold it at the right time, then you could have a super large ROI. Unfortunately, the data usually reveals that we're not that good at picking the winners and selling them at the right time. But that's besides the point. How we actually win as individual investors is by purchasing the entire index in the first place. And there is literally no work or no research that needs to be done on your part. You simply buy the index and you let the index do what it does. And the index will pretty much provide for you by itself. It has this really beautiful feature known as self-cleansing, where if a company becomes not as valuable as it used to be or not as profitable as it used to be, then it will slowly start to fall off the index. Like with the most recent example that I showed you when Dish Network was replaced by Palo Alto, however you say that. But anyway, if a company is not performing, it will just simply drop off the index. And therefore, the index is kind of self-cleansing. If a company is doing really, really well, then it will climb up the scale on the index. And you, as an individual index fund investor, will be able to take advantage of those gains without having to do any kind of additional research into individual company profits and losses and all this kind of stuff. Ultimately, bad companies will fall off of the index and good companies will make it onto the index. And if you are in it for the long run, meaning you're going to be investing for your entire lifetime and you hold through those good times and through those bad times, over time, what we have seen in the past, and we don't know if it's going to continue in the future, but what we have seen in the past over the entire life of the stock market is that if you were to buy and hold over long periods of time, the index fund will deliver great outsized returns for you that are mostly going to be superior to actively managed funds or to individual investors who try to pick stocks on their own. You, as an individual index fund investor, are probably going to outperform 90% plus of those other investors. Based on what I'm saying in this video, and if you've watched any of my other videos, you probably know that I am a high proponent of index fund investing, and that's what I do myself. But this leads me to the big question I want to know from you in the comments below. What is your investment strategy? Do you invest in actively managed mutual funds? Do you pick individual stocks? Are you a index fund investor or some kind of combination? Please let me know in the comments below. I'm really curious to hear what you have to say. And now, as I mentioned before, I did create another video that I like to call my complete guide to investing your way to financial independence. And in that video, I break down investing for a lifetime. And I think I did a pretty good job of making it very easy for the average everyday individual investor. So please check out that video if you haven't already, okay? It's gonna pop up right here on the screen right after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashFlow.com, and I hope to see you next time. Take a look at this really cool visualization. Come on. Visual. Why can't I say that word? Visualization. It is a hard word to say.